Look at your brokerage account right now. The numbers are flashing red. The charts are collapsing in a violent freefall. Turn on the financial news and you will see anchors speaking in panicked, breathless tones. They are talking about missile strikes in the Middle East. They are talking about Iran, about global escalation, about the closing of vital shipping lanes and the impending collapse of the modern world economy. They are doing everything in their power to trigger your deeply wired biological survival instinct. They are selling you fear. And fear is the single most profitable product in the history of the media industry. But today, we are going to remove the emotion. We are going to shatter the illusion. I am going to show you exactly what happens behind the closed doors of Wall Street when the first bombs drop. What you are seeing on your screen is not the end of the world. It is a mathematical equation of liquidity that has temporarily broken. And inside that exact fracture, the wealth of the next generation is born. Welcome to the anatomy of a global crisis. The average retail investor genuinely believes that the stock market crashes because people are afraid. They picture thousands of humans sweating over their keyboards, aggressively hitting the sell button in sheer terror. That is a fairy tale for beginners. The modern stock market is not controlled by human emotion. It is controlled by institutional algorithms. It is controlled by massive, computerized market makers. On a normal day, these algorithmic market makers sit perfectly in the center of the market. They buy and sell millions of shares in fractions of a millisecond, providing a smooth, continuous flow of liquidity. But what happens when an unexpected black swan event, like a sudden geopolitical strike in the Middle East, detonates on their data terminals? Algorithms do not know how to read political analysis. They do not understand the nuance of foreign policy. The only metric they are programmed to understand is a sudden, violent spike in statistical risk. When that risk crosses a predetermined mathematical threshold, the algorithms do the only thing they are programmed to do to protect their capital. They disconnect. They pull their bids. They walk away from the table. This creates a terrifying phenomenon known as a liquidity vacuum. The massive institutional safety net simply vanishes. The order book empties out. Suddenly, there are absolutely no buyers. And when there are zero buyers standing in the market, even a tiny, insignificant sell order can send the price of a world-class monopoly crashing down 10 or 20% in a matter of hours. I need you to understand this fundamental truth. This crash has absolutely nothing to do with the intrinsic value of the underlying business. Microsoft did not suddenly forget how to sell enterprise software because a missile was fired in the desert. ASML did not stop manufacturing the machines that print global microchips. The fundamental business models of these absolute monopolies are completely intact. The only thing that broke was the liquidity. And that is exactly when the violent domino effect begins. As stock prices fall freely into this empty vacuum, the true assassin of the financial markets is triggered. The margin call. There are massive multi-billion-dollar hedge funds that use extreme leverage. They borrow billions of dollars from prime brokers to gamble on highly speculative, dangerous positions. When the market violently drops, the prime broker's automated risk system flashes red. The broker picks up the phone, calls the hedge fund manager, and issues a margin call. They demand cash collateral immediately to cover the losing bets. Not tomorrow, not next week, right now. That over-leveraged hedge fund manager is now trapped in a financial nightmare. He needs to raise hundreds of millions of dollars in cash immediately to avoid bankruptcy. But he has a massive problem. He cannot sell his bad, highly speculative investments because we are in the middle of a liquidity vacuum. Nobody is buying garbage during a geopolitical panic. So what does he do? He is forced to sell his absolute best assets. He is forced to liquidate his crown jewels. He takes his shares of the most pristine, hyper-profitable, bulletproof monopolies on planet Earth, and he dumps them onto the open market at a massive 30% discount. He is not selling them because he thinks the business is failing. He is selling them blindly at any price available simply because they are the only liquid assets he has left to save his own life. This is not investing. This is a mechanical, forced liquidation, and this is your ultimate target. The smart money does not view a geopolitical war or a market panic as a catastrophe. The top 1% of investors view a crash as a historic mathematical subsidy. When the algorithms run away, the elite step in to take their place. When you buy a pristine asset at the exact moment of maximum global panic, you are not gambling. You are stepping up to become the liquidity provider for the market. You are handing a drowning hedge fund manager the cash he desperately needs, and in exchange, you are taking his finest assets for pennies on the dollar. For providing this critical service, the capitalist system will reward you with astronomical, life-changing returns the moment the dust settles, and the algorithms return to buy the stock back from you at full price. But how do you actually execute this without destroying yourself? If you blindly reach out to catch a falling knife, you will bleed out. You need a cold, calculated system. You need the sniper method. Here is the exact 3-step institutional blueprint to buy a geopolitical crash. Step 1. The arsenal of dry powder. You cannot take advantage of a crisis if your bank account is empty. While the amateur retail herd is fully invested, chasing green candles at the absolute top of a bull market, you must actively build a strategic reserve of cash. Cash during a period of peace feels like dead money. It feels boring. But in the dark heart of a geopolitical shock, cash is unexploded ammunition. It is your ultimate superpower. It gives you the power to buy the world when the world goes on sale. Step 2. The VIX and the sniper list. When the market is crashing, you do not turn on the television to listen to the news. You look at the data. There is a specific institutional metric called the VIX, the Volatility Index. It is the electrocardiogram of institutional fear. When a crisis hits and the VIX violently spikes above 35 or 40, that is your mathematical signal. That is the alarm bell confirming that the domino effect of forced margin calls has officially begun. At that exact second, your shopping list must already be prepared. You do not have the time to research new companies while the market is burning. You must already know exactly which wide moat monopolies and defense tech giants you want to own for the next decade. You write their names down. You calculate the exact discounted price you are willing to pay. You build your sniper list, and you wait in the shadows. Step 3. Tranche execution. This is the ultimate law of financial survival. Nobody on this planet, not even Warren Buffett, knows where the exact bottom of a market crash is. If you take your entire arsenal of cash and fire it into the market on the very first day of the panic, you are making a fatal mistake. If the war escalates the following week and the market drops another 15%, you are completely out of ammunition. You are paralyzed. You become a helpless spectator. You must divide your capital into strict, disciplined fractions. We call these tranches. If you have $30,000 in dry powder, you divide it into 3 bullets of $10,000 each. When your favorite monopoly drops by 15%, you fire the first bullet. You execute the trade without a single drop of human emotion. If the geopolitical situation worsens and the stock collapses another 10%, you do not panic. You smile, you fire the second bullet. You are systematically averaging down your cost basis into a company that will dictate the future of the global economy. You act like a cold, calculating machine. Look back at financial history. History is a perfect mirror. Whether we look at the pandemic crash of 2020, the Eastern European invasion of 2022, or the Middle East crisis today, the underlying mechanics are completely identical. The initial panic is blinding. The forced liquidations are brutal, but eventually the selling exhausts itself. The panic subsides, and those world-class monopolies violently snap back to their true fundamental value, leaving an ocean of asymmetric wealth for the few who had the mental discipline to buy the blood. The next time the television anchor tells you the world is ending, turn off the screen. The world does not end during a market crash. It simply changes owners. If you are ready to stop thinking like a victim and start operating like the architect of your own wealth, hit the subscribe button right now. We do not fear the crisis. We buy the panic. I will see you at the top.